Yesterday morning reminded me of an old lesson most investors never learn. When a market moves with violence, precision, and speed, it's rarely chaos, it's structure. Now, let's be very clear. What you're about to hear is not an accusation. It's an analysis of how modern markets can behave when power, leverage, and liquidity collide. Silver didn't just fall, it collapsed. And collapses like that don't happen because everyone suddenly changes their mind at the same time. They happen when liquidity is pulled. In futures markets, price is not set by belief, it's set by order flow. If a large participant chooses to sell aggressively into thin depth, price doesn't negotiate, it moves fast. That's not manipulation, that's mechanics. But here's the part investors struggle with. When one participant is large enough, their risk management becomes systemic. What looks like a trade to them becomes a shock to everyone else. Silver is especially vulnerable to this dynamic. Why? Because it's a thin market with deep leverage. Futures allow massive exposure with very little capital. That's efficient in calm times and devastating in stress. When large sell orders hit a leveraged market, margin calls cascade. Forced selling creates more selling. Stops trigger stops. Liquidity disappears exactly when it's needed most. At that point, price is no longer discovery, it's liquidation. Now, zoom out. Ask yourself a calmer question. If a market rally attracts leverage, leverage attracts crowded positioning. What happens when someone decides to exit all at once? It doesn't matter whether that exit is smart, defensive, or opportunistic. The outcome is the same. The crowd pays. This is why long-term investors don't confuse price action with truth. Price is a vote. Liquidity is power. And power doesn't announce itself. It moves quietly, legally, mechanically. Another uncomfortable truth: markets don't exist in isolation. A sharp move in one asset changes narratives in others. When fear trades unwind, risk trades benefit. Capital doesn't disappear, it rotates. That's not conspiracy, that's portfolio math. So when you see extreme moves, don't ask, who's guilty? Ask instead, who was positioned for this? Because the winners in markets are rarely the loudest voices. They're the ones who understand structure, timing, and incentives. Silver didn't fail yesterday, leverage did. And the lesson isn't about one metal. It's about understanding that markets reward patience, not conviction. They reward preparation, not emotion. And most of all, they punish certainty. In my lifetime, every generation believes the market is finally honest, right up until the moment it teaches them humility. Focus on what you can control. Avoid leverage you don't need. And remember, markets don't owe us fairness. They only offer opportunity to those who respect risk.